It is competing with artificial intelligence. It is competing with chip stocks. It is competing with mega-cap tech. It is competing with private market excitement. It is competing with the kind of SpaceX-style story where investors believe the next massive opportunity is somewhere newer, bigger, and more exclusive. That is why this moment is dangerous for retail. When Bitcoin falls, most people ask, is this the bottom? But smart money asks a different question. Is the buyer still there? That is the whole story. A Bitcoin chart can still look interesting. A support level can still hold for a few hours. A bounce can still happen after a sharp sell-off. But if the ETF bid is fading, if the Federal Reserve is not giving markets an easy rate cut story, and if capital is rotating toward another narrative, then a bounce is not automatically a recovery. A bounce without liquidity is just a candle, and candles can lie. Liquidity is harder to fake. This is where retail usually gets trapped. Retail sees Bitcoin down and thinks the opportunity is cheaper. Wall Street sees Bitcoin down and asks whether the marginal buyer is still strong enough to defend the trade. That is the key question today. Who is the marginal buyer for Bitcoin? If the marginal buyer is still strong, then a pullback can become a reset. Bitcoin can shake out weak hands, rebuild demand, and move higher again. But if the marginal buyer is tired, if ETF flows are not confirming, and if macro liquidity is not helping, then the same pullback becomes something very different. It becomes a liquidity test. And a liquidity test does not always look like a crash at first. Sometimes it looks like Bitcoin bouncing and failing, bouncing and failing, bouncing and failing. Each bounce gives retail just enough hope to stay interested, but each failure tells you the buyer behind the move may not be strong enough. That is why this market feels so confusing. Bitcoin is weak, but the stock market is not dead. Some tech names are trying to rebound. AI is still attracting attention. Chip stories are still powerful. Wall Street still has something to chase. And when Wall Street has something else to chase, Bitcoin needs more than hope. It needs confirmation. This is the difference between price and liquidity. Price gets attention. Liquidity decides. In the previous cycle, Bitcoin was one of the cleanest expressions of speculation, liquidity, and anti-Fed emotion. When money was easy, Bitcoin could dominate the attention map. It was the risk asset. It was the rebellion trade. It was the liquidity trade. But today, the attention map is more crowded. AI is taking attention. Mega-cap tech is taking attention. Chip infrastructure is taking attention. Private market growth stories are taking attention. And when attention moves, liquidity often follows. That does not mean Bitcoin is dead. It means Bitcoin has to prove that demand is still there. And this is where the average viewer feels the real pressure. You are not only afraid that Bitcoin goes lower, you are afraid that you are holding the wrong story. You see Bitcoin struggling around a key zone. You see ETF outflows. You see the Federal Reserve staying hawkish. You see Wall Street talking about AI, chips, tech, and the next big growth trade. And suddenly the question becomes emotional. Am I early or am I exit liquidity? That is the question retail never wants to ask out loud, but it is the question the market forces you to answer. This is why panic is not a strategy. FOMO is not a strategy either. The calm metrics way to read this market is simple. Do not ask only whether Bitcoin can bounce. Ask whether liquidity is confirming the bounce. There are 3 signals to watch now. First, watch whether Bitcoin can reclaim its lost range with strength. Not just a weak candle, not just a short squeeze, not just a temporary bounce. A real recovery should look like demand returning. Second, watch ETF flows. If Bitcoin tries to bounce but ETF demand keeps fading, then the move is weaker than it looks. Price can create excitement for a few hours. Flows tell you whether institutions are still supporting the trade. Third, watch the Federal Reserve and yields. If the market has to price higher for longer policy or even rate hike risk, then speculative assets do not get the same easy oxygen they had during softer liquidity periods. That is why Bitcoin traders should not only watch Bitcoin, they should watch where the money is going. If AI and tech keep attracting attention while Bitcoin struggles, that is rotation. If yields pressure risk assets while Bitcoin fails to reclaim key levels, that is macro resistance. If ETF flows remain weak while retail keeps buying every dip, that is a warning. Again, this is not a prediction that Bitcoin must crash. Markets are not that simple. Bitcoin can bounce sharply. Short squeezes can happen. Headlines can change quickly. Whale accumulation can support the market even while ETF flows look weak. But the bigger lesson is this: a bounce without liquidity is not the same thing as a real recovery. Retail watches the candle. Smart money watches the buyer behind the candle. And right now, that buyer is the whole story. So if you are watching Bitcoin today, do not reduce the market to one question: should I buy or sell? Ask a better question. Is Bitcoin still the trade Wall Street wants to chase? Or is Wall Street already chasing something bigger? Because if Bitcoin is bleeding while the next major growth story is stealing the room, then the risk is not only price going lower. The risk is attention moving on before retail notices. And in markets, attention is not just attention. Attention is liquidity waiting to choose a side.